going to move forward a little bit more, and we're going to look at the modified income statement. So we're going to take the basic knowledge of cost behavior, fixed, variable, semi-variable, and we're going to put it to work by creating what's called the contribution margin format income statement. So it's a different income statement than the one that you see in the externally published financial statements. This is an income statement format that is only used internally. Both the traditional and the contribution format are going to report the same operating income. But when we look at them, we see that they come at them from a different perspective. The traditional income statement format is used for the external reporting purposes. It emphasizes expenses classified by their function. Based on the traditional format, cost of goods sold is subtracted from revenue to arrive at gross profit. Operating expenses are then subtracted from the gross profit to arrive at operating income. Where the contribution margin format, which is only used internally, primarily by management, emphasizes expenses classified by their cost behaviors. Based on the contribution format, variable expenses are subtracted from revenues to arrive at what we call the contribution margin. Fixed expenses are then subtracted from this contribution margin to arrive at operating income. Note that both have the same operating income. We just come at this from a slightly different perspective. This is a great representation of how it's the exact same information that we're using. Now, somebody may not make you a contribution format. And as a manager, you may need to do that. You would know then that you would have the same operating income, and you would need to go through those lists of expenses, and you would need to classify everything appropriately. The contribution margin format derives its name from the difference between revenues and variable expenses, which is the contribution margin. This is the amount that is available to contribute to fixed expenses and operating income from the sale of products or services provided. The basic key to this concept lies in understanding those cost behavior patterns. As revenue increases, so as $100,000 would increase as a result of selling more products or providing more services, those variable expenses would also increase proportionally. And then so would the contribution margin. However, those fixed expenses won't be increasing because they're not a function of the level of revenue generating activity. So we look at what is going to be able to be changed. Your contribution margin is the amount that is able to contribute towards fixed expenses and operating income. The contribution margin format, which derives its name from the difference between revenues and variable expenses. In managerial accounting, the term costs and expenses are often used interchangeably. This is not necessarily true in traditional financial accounting, as you will recall. However, managerial accounting does use a completely different vernacular and jargon. The contribution margin means that this is the amount that is available to contribute to fixed expenses and operating income from the sale of products and the provision of services at a given set amount. So to illustrate the use of this model, let's assume management says what would happen to our operating income from a specific product that has these revenue, costs, and volumes as shown in blue. We have a total contribution margin of $48,000 and fixed expenses of $40,000. So the company produced $8,000 of operating income during the period. This is if they have sales volume in cases at 8,000. Using this same logic, this same format, this basic equation model here, we can say, how about if management wanted to know what would happen to the operating income if a $3 per unit price cut were to result in a volume increase of 5,000 units. So advertising says, let's do a sale, and we expect we'll get an additional 5,000 units sold. So now we're going to have a total of 13,000 units. So what would happen to the operating income under this assumption? The company will produce a contribution margin of $39,000. But those fixed expenses don't change, and they continue to be $40,000. So the company would actually experience an operating loss of $1,000 if management was to lower the price $3 per unit. The increase of 5,000 units does not offset appropriately to make this a wise decision. Let's look at another what if. That's what a lot of managerial accounting is. And what you will do as managers is what if. This is what we're expecting. If that happens, can we make that decision? Well, you can't make that decision without all the information. And we pull that information from the accounting information system. From historical perspective, we have been selling it at $15 a unit. We have variable expenses per case historically that we can recognize at 9, and our fixed costs, our fixed expenses are $40,000. These are known historical quantities that have backup associated with them. So underneath a different assumption, management proposes the same $3 per unit price cut in conjunction with a $3,000 increase in advertising, with the expectation that the volume will increase to 18,000 units. As you can see, the company will produce a contribution margin of $54,000, while the fixed expenses will increase to $43,000. Net operating income is then $11,000. The analysis suggests that if the volume increase can be achieved with the price cut and increasing the advertising contribution, operating income will increase from its present level, and this would be an affirmative type of decision that management might make. If a product line, so when we look at contribution margin ratios, we can look at it underneath a variety of ways. We can look at it on a per product, we can look at it underneath a product mix. So if a product line had a contribution margin ratio of 30%, would an advertising program costing $21,000 be cost effective if it generated an additional $80,000 of revenue? This is a common thumbnail scenario. This type of scenario would increase operating income by $3,000. So yes, the program would be effective. Alternatively, dividing the increased fixed expenses by the contribution margin ratio. So if we take 21,000 and we divide that by 30%, that shows that an additional $70,000 of revenue would be needed to cover the increased fixed expenses. We are expecting $80,000 of revenue. So we know that this would be an affirmative type of a decision. You should recall from other business classes that the sales mix is the relative combination in which a company's different products are sold. Different products are going to have different selling prices, costs, and individual unit contribution margins. Changes in the sales mix will result in a different total contribution margin ratio. So let's look at yard care. For yard care, both products have the same sales volume of 1,000 units, but each product has a different contribution margin ratio. Lawn mowers are at 40%, whereas the lawn tractors are at 55%. But when we combine the aspects of the entire mix, we come out with a 48% contribution margin ratio. The average total contribution margin ratio provided from all of the products is 48%. That is the $265,000 of contribution margin divided by the $550,000 in sales. That's how we determine the contribution margin. How will the average total contribution margin change if Jones sold 1,500 lawn tractors and all other factors were held constant? Again, this is the type of question that is often brought to different managers. What would be the difference if we did X? So how will average total contribution margin change if we sold 1,500 tractors, all other things held constant? We changed the center columns where the lawn tractors are, and then we carried through with our totals. The average total contribution margin ratio provided from all the products is 50%. That is $347,500 in contribution margin divided by total sales of $700,000. This ratio increased from 48% to 50% as the result of selling more products with a higher contribution margin ratio. Next, we're going to talk about break-even point analysis. So according to the break-even model, that is when our contribution margin is equal to fixed expenses. So we take fixed expenses and we divide it by the contribution margin per unit, and that will tell us how many units we need to break even. Now this works really good if you only have one item. If you have more than one item though, that may not work so well because we may be dealing with a product mix. So then what we can do is we can take our fixed expenses divided by that contribution margin ratio, that total contribution margin ratio, and that's going to tell us what our revenues need to be at break even for us to get to break even. And then we can take those total revenues that are required, divide it by a revenue per unit, and that will tell us what our volume in units at break even is. So we can come at this from a couple of different ways, but break even is the point in which contribution margin will cover all fixed expenses, and you would result in an operating income of $0. The break-even formula can be modified to determine amounts by adding things such as desired operating income to the numerator. To illustrate this, let's assume the basic information we have been using and add the desired operating income of $10,000. We add the fixed expenses to a desired profit level, so desired operating income, and then we divide that by the contribution margin per unit to arrive at a break-even of 13,750 units. That means that we would have covered our fixed expenses and we would arrive at a desired operating income or a target income when we sell 13,750 units. We can then also do this from a revenue perspective by taking those fixed expenses and the desired operating income and dividing them by the contribution margin ratio. And that says that we would need to achieve $165,000 in revenues in order to arrive at $10,000 of operating income. Break-even is sometimes represented using a break-even graph. Using data from those previous examples, note that in these graphs, the horizontal axis is sales volume in units, and the vertical axis is total dollars. The horizontal line represents fixed expenses of $45,000. And variable expenses of $8 per unit are added to the fixed expenses to produce the total expense line. Revenues start at the origin and rise at the rate of $12 per unit in proportion to the sales volume in units. The intersection of the total expenses line and the total revenue line is the point at break even. The company must sell 11,250 units to break even. Once they surpass that point, you see in orange where we have the profit relationship. Now, another aspect that you would be concerned with as a manager is operating leverage. When an entity's revenues change because their volume of activity changes, variable expenses and contribution margin change proportionally. But the presence of fixed expenses, which do not change as that volume of activity moves, means that operating income will change proportionally more than the change in revenues. This magnification of the effect on operating income resulting from a change in revenues is called operating leverage. So let's look at this just a little bit more. Operating leverage is a measure of how sensitive net income is to a percentage change in sales. With high leverage, a small percent increase in revenue can produce a much larger percentage increase in income. Using data from Golf Company here, if revenues were to increase by 20%, what is the percentage increase in income. Let's take a look at that. Operating leverage resulted in an operating income increasing proportionally more than the increase in revenue. The company realized an 80% increase in income as a result of a 20% increase in sales. So we had a 20% increase in sales. We went from 100,000 to 120,000. However, we went from 10,000 to 18,000 in operating income.